Welcome to the deep dive.
Hmm.
You know that feeling, right? That annual scramble when tax season hits, especially if you're running a corporation.
Oh, yeah,
It just feels like this wave of forms, super complex instructions, jargon everywhere. It makes your head spin.
it really does. But, what if that overwhelming wave actually held, like, hidden currents, opportunities for some real strategic financial management?
That's an interesting way to put it.
It's true. Most businesses just see tax returns as, well, a chore, something they have to do. But if you look closer, a corporate tax return, especially Form 1120, it's actually a powerful tool.
Right.
It's not just about what you owe the government. It's about what you can strategically keep.
Absolutely. So today we're taking a deep dive into Form 1120, the U.S. Corporation Income Tax Return.
The big one for C-Corp.
Exactly. And our mission here is really to cut through all that noise, make sense of the, let's be honest, intricate instructions, and just systematically break down how you prepare it.
Yeah, step by step.
We'll uncover some surprising insights, hopefully, provide clarity, and crucially, pinpoint specific areas where you, as a corporation, can genuinely save money. Think smart deductions, valuable credits.
hmm
Consider this your shortcut, your fast track to being well-informed without feeling totally swamped.
And just to be clear, everything we're talking about today is grounded directly in the official 2024 instructions for Form 1120.
Straight from the source.
Exactly. So it's accurate, it's actionable, you can use this stuff.
Oh, okay, let's do it. Let's unpack this thing. Starting with the absolute essentials of Form 1120. So first off, what's its main purpose and who has to file this specific form?
Right. So Form 1120, it's really the backbone of corporate tax reporting here in the U.S.
Yeah.
It's where a domestic corporation lays out everything financially for the year,
All the numbers.
all the numbers, income, gains, losses, deductions, credits,
Mm-hmm.
the whole picture. And all of that flows into calculating their federal tax liability. It's basically the IRS's main window into the company's financial health for tax purposes. Now, who must file? Primarily, it's domestic corporations. C-Corp, basically. And this is really a key first step. Not every entity you might think of as a corporation actually uses this specific form.
Ah, okay, so it's not a one-size-fits-all deal for corporate returns. You might be incorporated but file something else.
Precisely. This is like the first hurdle people often trip over. For instance, a tax-exempt organization, if they have unrelated business income, they're filing Form 990T, not 1120.
Okay.
LLCs, limited liability companies.
Mm.
If they elect to be treated as partnerships for tax purposes, which many do they file, Form 10065.
The partnership return.
Right. And probably the most common one people know is S corporations. They get that flow-through tax treatment, so they file Form 1120S.
Oh,
Even REITs, real estate investment trusts, they have their own specialized form, 1120 REIT.
wow.
So honestly, the most critical first step for any business is nailing down which specific form applies to their structure. Get that wrong, and
You're starting off on the wrong foot, completely.
exactly, it can derail the whole process.
Understood. Okay, knowing your form is step one, absolutely crucial. Once you've got the right document, the next big practical question is when? When does this need to be filed, and where does it actually go? What are the deadlines we need burned into our brains?
Deadlines, yeah, always critical with the IRS. So the general rule for most corporations, the standard C Corp, is that Form 1120 is due on the 15th day of the fourth month after the end of their tax year.
Okay, so for most companies on a calendar year.
That's April 15th, just like individual taxes.
Got it.
But there's a little wrinkle. If your corporation's fiscal year ends on June 30th, your due date is actually a month earlier. It's the 15th day of the third month after your year end, so September 15th.
Okay, good to know.
And of course, the usual rule applies. If any of these due dates fall on a Saturday, Sunday, or a legal holiday, the deadline automatically shifts to the next business day.
Okay, that helps. But what if you're just running behind? You can't make that deadline.
It happens all the time.
Yeah,
That's where Form 7004 comes in clutch. It's the application for automatic extension of time to file.
it's automatic.
Automatic 6-month extension. You file Form 7004 by your original due date, and boom, you get 6 more months to file the return. No questions asked. It's a lifesaver for a lot of businesses.
Okay, 6 months to file. But crucially, not 6 months to pay, right?
Absolutely critical distinction. An extension to file is not an extension to pay your taxes. You still need to estimate what you owe and pay it by the original due date to avoid penalties and interest.
Gotcha. Now, about actually sending it in, mail,
Yeah.
online, are there options?
You can mail it via the good old U.S. Postal Service, of course. But the IRS also designates certain private delivery services, PDS, think FedEx, UPS, DHL. Using an approved PDS gets you the benefit of the timely mailing as timely filing rule.
Meaning if you ship it by the deadline, it's considered on time, even if it arrives a bit later.
Exactly. Just one practical tip there. PDS generally can't deliver to P.O. boxes. So if the IRS Service Center for your return uses a P.O. box address, you'll need to use the USPS.
Good tip. And speaking of service centers, I know where you file depends on location and size, right? How does that work?
It does. It mainly depends on the corporation's principal business location and its total assets. It gets a bit specific, like if your main office is in, say, Connecticut or New York or Florida, and your total assets are less than $10 million, and you're not required to file Schedule M3, then you'll likely file with the Kansas City MO Service Center.
Okay.
But if your assets hit that $10 million mark, or if you're filing Schedule M3, even in those same states, it usually flips to the Ogden UT Service Center.
Interesting.
And then states like California, Texas, Wyoming, regardless of asset size, they generally file in Ogden. And if you're operating internationally, there's a specific P.O. box in Ogden for that.
So you really need to check the instructions based on your specific state and asset level.
Definitely. Oh, and one more thing. If you're part of a group of corporations, maybe spread across different areas, you might be able to consolidate your filing. If the main corporation keeps all the books at its principal office, the whole group can often file all returns at the service center for that main office. It can make things a lot easier.
Yeah, I can see how that would streamline things for bigger groups. Okay, returns prepped, address figured out. Who actually signs this thing? Who has the authority?
Good question. It needs an authorized signature.
Mm-hmm.
Typically, that's a corporate officer. President, vice president, treasurer, assistant treasurer, chief accounting officer, one of those folks.
Standard C-suite rules.
Right. Or it could be any other corporate officer who's been specifically authorized to sign tax documents, maybe a dedicated tax officer. Now, if the corporation is in a special situation, like a receivership or bankruptcy with a trustee or an assignee handling things, then that fiduciary, the receiver or trustee, is the one who must sign.
And they'd need proof of that authority.
Yep. In those cases, you have to attach a copy of the court order or instructions that give them the power to sign for the corporation.
Makes sense. What about the folks who often do the heavy lifting, the paid tax preparers? Do they sign too?
They do. There's a whole section labeled Paid Prepare Use Only. If an employee of the corporation prepares the return internally, or if a friend helps out for free, that section stays blank.
Okay.
But if you pay someone to prepare your Form 1120, they generally have to complete that section. That means signing the return. They can even use a rubber stamp or software signature sometimes, including their Preparer Tax Identification Number, their PTIN, and they must give you, the corporation, a complete copy of the return for your records.
Right, you need your copy. I've also seen that box you can check. Authorizing the IRS to talk to the paid preparer directly. What does that actually allow, and what doesn't it allow?
Ah, yes, the third-party designee box.
Yeah.
Checking yes there gives the IRS permission to contact the specific preparer who signed the return, but it's pretty limited authorization.
For what kind of things?
Mostly for resolving processing issues, like they can answer questions that pop up while the IRS is processing the return, give missing information if needed, ask about the status of the return or a refund, and respond to certain basic notices, like for math errors or if a refund is being offset.
Okay, so practical processing stuff.
Exactly. But here's what it absolutely does not allow. The preparer cannot receive your refund check, they can't bind the corporation to any additional tax liability, and they can't represent the corporation in broader matters like an audit or an appeal. It's not a power of attorney.
Got it. It's very specific, very limited, and temporary too.
Very temporary. It automatically expires no later than the due date, excluding extensions, for filing the corporation's next year's tax return. If you need more authority or want to revoke it sooner, you'd look at IRS Publication 947.
Okay, so returns filled out, signed, authorization box considered. How do you actually assemble the whole package? Is there a specific order for all the schedules and attachments? You can end up with a pretty thick stack.
Oh, you definitely can. And yes, there's a very specific stacking order the IRS wants you to follow. It's critical for their processing. After page 6 of the main Form 1120, you start attaching other schedules and forms in a precise sequence.
Like building blocks.
Kind of. Think of common schedules like Schedule D for capital gains or Form 4797 for sales of business property. Those come pretty early. Then there's a long list of numerical forms followed by alphabetical schedules, then more numerical forms, and finally, any supporting statements or attachments.
So don't just staple it all together randomly.
Please don't. Follow the sequence listed in the instructions. It really helps things move smoothly on their end. And just as important, complete every applicable entry space on the Form 1120 itself. Don't write "see attached" or "available upon request."
I hate that.
They really do. If you need more space, use separate sheets, but make sure they're the same size and format as the official forms. And critically, put the corporation's name and employer identification number, the EIN, on every single supporting sheet.
Name and EIN on everything. Got it.
Oh, and one more attachment point. If you had federal income tax withheld on payments you received, maybe shown on a Form 1042-S, 8805, or 8288A, you must attach those forms to claim that withholding credit properly on your return.
Makes sense. You need the proof. Okay, that's a lot of meticulous detail, but I guess precision is key with the IRS. Let's shift gears to paying the tax. How and when does that happen?
Right, the money part. Generally, any tax you owe has to be paid in full by the original filing due date of the tax return, even if you get that 6-month extension to file.
The payment is still due April 15th for most.
Exactly. Extension to file, not extension to pay. And if that payment due date falls on a weekend or holiday, it bumps to the next business day. Now, here's a really critical point for corporations. You are required to pay electronically.
Required, no paper checks.
Pretty much required. You have to use the Electronic Federal Tax Payment System, or EFTPS, for essentially all federal tax deposits. That includes employment taxes, excise taxes, and absolutely corporate income taxes.
EFTPS, is that hard to use?
It's actually a free online service from the Treasury Department. It's the primary way the IRS expects corporations to pay. If a company really doesn't want to use EFTPS directly, they can arrange for their bank or a payroll service to make the deposits for them, but it still has to happen electronically. This mandate is pretty strict.
Okay, electronic payments are the rule. What about estimated taxes during the year? Do corporations have to pay as they go?
Yes, absolutely. For the vast majority of corporations, estimated tax payments are mandatory. If a corporation expects its total tax for the year after credits to be $500 or more, it must make installment payments of estimated tax throughout the year.
How often? Quarterly.
Generally quarterly, yeah. The due dates are typically the 15th day of the 4th, 6th, 9th, and 12th months of the corporation's tax year. Same weekend holiday rule applies, and these estimated payments also must be made electronically via EFTPS.
So 4 payments a year electronically.
Right. And from a planning perspective, it's really important to refigure your required installments if your corporation's income or tax liability changes significantly during the year, because underpaying your estimated taxes can lead to penalties.
Penalties. We'll get to those. But what if you go the other way? What if you overpay your estimated tax significantly?
Good question. If you realize you've way overpaid, you might be able to get a quick refund before you even file your annual return. You'd use Form 4466, Application for Quick Refund of Overpayment of Estimated Tax.
A quick refund sounds nice. Are there catches?
There are conditions. The overpayment has to be at least 10% of your expected income tax liability for the year, and it has to be at least $500. If you meet those thresholds, Form 4466 can get some of that cash back in your hands faster.
Okay, that's useful. Now, the scary part. What happens if a corporation messes up, misses a deadline, underpays, etc.? Let's talk interest and penalties. This is where things can get expensive, fast.
You're right. The IRS definitely has consequences for non-compliance. First off, there's interest. Interest is charged on any tax paid late, even if you had an extension to file.
Interest starts from the original due date.
Yes.
Yeah.
And it also applies to penalties themselves, like failure to file penalties, accuracy penalties, fraud penalties. Interest just keeps accruing until the bill is paid.
Okay, so interest is automatic on late payments. What about penalties for filing late?
The late filing penalty. If your return isn't filed by the due date, including extensions, it's 5% of the unpaid tax for each month or part of a month it's late. And that caps out at 25% of the unpaid tax.
5% a month. That adds up quickly.
It does. And for returns due in 2025, if you file more than 60 days late, there's a minimum penalty. It's the smaller of the actual tax due, or $510. Now, you might get this penalty waived if you can show reasonable cause for filing late, but
That's a high bar.
it's a very high bar to clear, yeah.
Don't count on it.
Okay, that's filing late. What about paying late? There's a separate late payment penalty. That's generally 12 of 1% of the unpaid tax for each month or part of a month it remains unpaid. This one also caps out at 25% of the unpaid tax. It's lower than the late filing penalty, but it still adds up.
0.5% per month. Okay. Are there other, maybe more serious penalties?
Oh, yes. A particularly nasty one is the trust fund recovery penalty. This applies if a corporation collects or withholds certain taxes, think payroll taxes like Social Security and Medicare, or certain excise taxes, but then doesn't pay them over to the IRS.
These are taxes held in trust for the government.
Exactly. And this penalty is harsh because it can be assessed personally against the individuals who were responsible for collecting and paying those taxes and who willfully failed to do so. Officers, directors, certain employees.
So it pierces the corporate veil.
It absolutely can. And the penalty amount is equal to the full amount of the unpaid trust fund tax. It's designed to be a very strong deterrent.
Wow. Okay, definitely want to avoid that one. Any others we should know about?
Yeah, there's a range. Penalties can be imposed for negligence or disregarding the rules, for a substantial understatement of your tax liability, for understatements related to specific reportable transactions. Those penalties can be huge. And, of course, for outright fraud.
Right.
And circling back to estimated taxes, if you don't pay enough on time throughout the year, you could face the estimated tax penalty. You calculate this using Form 2220.
Do you always have to file Form 2220 if you owe a penalty?
You use it to figure the penalty, yes.
Yeah.
But here's the tricky part. Even if you don't owe a penalty, you must file Form 2220 if you use certain methods to calculate your installments, like the annualized income method or the adjusted seasonal method, or if you're a large corporation, calculating your first installment based on the prior year's tax.
Why file it if you don't owe anything?
Because if you used one of those methods and don't attach Form 2220 showing your calculation, the IRS system might automatically flag you for a penalty based on a standard calculation. Then you'd have to go through the hassle of requesting an abatement. Filing the form proactively avoids that potential headache. It shows your work.
Ah, okay. Better to file it and show how you got there. So many potential pitfalls. Let's shift to something more fundamental. Accounting. How does a corporation track its money for tax purposes? What are the allowed methods and periods?
Right. This is absolutely fundamental. A corporation generally figures its taxable income using the same accounting method it uses for its regular books and records. But that method must clearly reflect taxable income in the eyes of the IRS.
What are the main methods allowed?
The big two are the cash method and the accrual method. There are other specialized methods too, but those are the main ones. Cash method means you generally recognize income when you receive it and deduct expenses when you pay them. Accrual means you recognize income when you earn it, regardless of when you get paid, and deduct expenses when you incur them, regardless of when you pay. Okay, cash versus accrual. Can any corporation choose either one?
No, and this is a major restriction. Generally, C corporations or partnerships that have a C corp as a partner cannot use the cash method.
Really? Most corporations can't use cash.
Not unless they qualify as a small business taxpayer. That's a really significant limitation. If you're not a small business taxpayer, you're generally stuck with the accrual method, especially if you have inventory. The rule is, unless you're a small business taxpayer, you generally must use an accrual method for inventory sales and purchases.
Inventory forces you into accrual, usually. Usually, yes. Farming businesses also generally use accrual, though there are exceptions. And there are special rules for things like long-term construction contracts and dealers and securities.
Okay, so that small business taxpayer status sounds pretty important. It gives you more flexibility, like potentially using the cash method. What defines a small business taxpayer for, say, 2024?
Good question. For tax years beginning in 2024, a corporation qualifies as a small business taxpayer if its average annual gross receipts for the 3 prior tax years were $30 million or less.
$30 million average over 3 years.
Right. And it can't be classified as a tax shelter. If you meet both those tests, you get significant flexibility. You might be able to use the cash method, and you get simpler options for accounting for inventory.
How does inventory accounting change for small businesses?
If you qualify as a small business taxpayer, you can account for inventory, either by treating it as non-incidental materials and supplies, or you can follow the method you use in your applicable financial statements, like audited financials. If you don't have applicable financial statements, you can just use the method you use in your own books and records prepared according to your accounting procedures. Much simpler than the complex inventory rules larger companies face.
That sounds like a huge simplification. What if a company needs to change its accounting method? Say, from cash to accrual because they grew.
Changing your accounting method generally requires getting IRS consent. And you usually do that by filing Form 3115, Application for Change in Accounting Method. It's not always a simple process, but it's necessary if your situation changes or you realize you've been using an impermissible method.
Okay. So understanding those accounting rules and the small business definition is key. Beyond the act of filing and accounting, what about just keeping records? Why is it so critical to hang on to copies of everything?
Record keeping seems basic, but oh man, it's absolutely critical. Corporations need to keep copies of all their filed tax returns, Form 1120, all the schedules, all the attachments, everything, plus all the supporting documents. Invoices, receipts, bank statements, ledgers.
Why? What are they used for later?
So many things. They are invaluable when you're preparing future tax returns. Think about carryovers, net operating losses, capital losses, credit carry-forwards. You need the prior year returns to track those accurately. Recurring deductions, depreciation schedules. It all builds year over year.
Makes sense for continuity.
Exactly. They're also essential if you ever need to file an amended return of Form 1120-X to correct a mistake or maybe claim a deduction you missed. You need the original return as your starting point. And beyond just filing, these records are necessary for calculating the corporation's earnings and profits, or E&P. That's a crucial tax concept that affects things like whether shareholder distributions are taxed as dividends. And of course, if the IRS ever comes knocking for an audit or just asks questions, your meticulous records are your only defense. They are the foundation for proving everything on your return. Good records are just fundamental tax hygiene.
Bedrock of good tax hygiene. I like that. Okay, we know about Form 1120 itself, but there are always other forms, statements. What are some key supplementary forms or disclosures listeners might run into?
Definitely. We mentioned Form 1120-X for amending a return. Another really big area triggering extra forms is reportable transactions.
That sounds serious. What are they?
They are. These are transactions the IRS has identified as having a potential for tax avoidance or evasion. They fall into categories like listed transactions, specific schemes the IRS has called out transactions offered under conditions of confidentiality, deals with contractual protection against the IRS disallowing the tax benefits, or transactions resulting in significant losses.
So things the IRS is specifically watching.
Exactly. If your corporation participates in one of these, you must disclose it by filing Form 8886, Reportable Transaction Disclosure Statement.
And I bet the penalties for not filing that are pretty steep.
Oh, incredibly steep. Failure to file Form 8886 when required can lead to massive penalties under Section 6707A. We're talking potentially tens or even hundreds of thousands of dollars, depending on the transaction type. Plus, other accuracy-related penalties might apply too. This is not an area to mess around with. Disclosure is mandatory.
Okay, duly noted. Avoid those penalties. What other forms might pop up?
Well, there are specific statements or forms required for certain corporate reorganizations or transfers, like transfers to a controlled corporation under Section 351 or certain distributions under Section 355. If you have dual consolidated losses, losses from entities taxed in both the U.S. and a foreign country, there are complex rules and reporting. There's an election related to basis adjustments for certain property transfers. It gets pretty technical.
Yeah, it sounds like territory for specialists.
Often, yes. Also, if your corporation is a specified domestic entity holding significant foreign financial assets, you might need to file Form 8938. And for really large multinational groups, think annual revenue of $850 million or more, they have to file Form 8975, the country-by-country report, detailing their global operations.
That's a whole other level of complexity for the big players. What about something more recent that affected tons of businesses? The Paycheck Protection Program, PPP loans. How does the tax-exempt income from loan forgiveness fit into the 1120?
Right, PPP was huge. If your corporation received a PPP loan and had some or all of it forgiven, that forgiven amount is generally tax-exempt income. But you still need to deal with it on the return. You need to attach a statement to your Form 1120.
What does the statement need to say?
It should detail each tax year for which the corporation is applying the special IRS guidance related to PPP forgiveness. For the current tax year return, it needs to include specifics for each PPP loan, basically confirming how you're treating that tax-exempt income. It ensures transparency about how you handle that relief money on the tax side. The IRS is definitely keeping an eye on all the COVID-related relief programs.
Makes sense. Okay, that covers a ton of the essential groundwork, compliance, deadlines, pitfalls. Now let's get to the really interesting part for many businesses. The heart of Form 1120 itself. The income section, and even more importantly, the deductions. This is where strategic planning really pays off.
Absolutely. This is where understanding the rules translates directly into tax savings.
Let's start right at the top of page 1, the basic identifying info. Seems simple, but are there nuances there we should be aware of?
Even the simple stuff has details, like the EIN, Employer Identification Number. If your corporation is new and doesn't have one, you should apply online well before you need to file. You can often get it immediately that way, which is super convenient. You absolutely need an EIN to e-file. with very rare exceptions for some consolidated group subsidiaries.
So get the EIN early.
Definitely. Then you have the checkboxes. Initial return, if it's your very first Form 1120. Final return, if the corporation ceased to exist during the year. Name change or address change. Make sure you check those if applicable. If you change your address after filing, you need to use a separate form, Form 8822B, to notify the IRS.
Okay, and what about that total assets line? Why is that important?
Total assets, usually taken from Schedule L, the balance sheet, seems straightforward, but it's actually a critical number. It's one of the main factors determining if your corporation is considered small or large for various tax purposes. As we mentioned, being small, $10 million or less in assets generally, can mean less burdensome reporting, like not having to file Schedule M3. Being large triggers extra requirements, so that number has real consequences.
Got it. Basics covered. Now let's talk money coming in. The income section, lines 1 through 10. How does a corporation report its revenue and other income?
Right. Lines 1 through 10 capture all the inflows. It starts with line 1A, gross receipts or sales. That's your top-line revenue from your main business activities. Some qualifying corporations might use a special accounting method here called the non-accrual experience method for certain income they don't expect to collect. If so, they attach a statement detailing that. Line 1B is for returns and allowances, where you subtract refunds you gave to customers. Pretty standard. Then line 2 is cost of goods sold, or COGS. This is a huge deduction for many businesses, but you don't just put a number here. You have to complete and attach a separate form, Form 1125A, to show the calculation.
So Form 1125A backs up the COGS number.
Exactly. Then you skip down to line 10, other income. This is the catch-all for income that doesn't fit neatly into gross receipts or other specific lines.
What kind of things end up in other income? This sounds like where miscellaneous stuff goes.
It is, and it can be varied. For example, if you previously deducted a bad debt using the specific charge-off method, and then you unexpectedly recover some or all of that debt later, that recovery amount is income, reported on line 10.
Okay. Money you thought was gone comes back.
Right. Also, certain amounts related to biofuel or renewable fuel credits might be included here. Refunds of state or local taxes that you deducted in a prior year could be income here, but only if that prior deduction actually gave you a tax benefit.
The tax benefit rule.
Exactly. You'd also report ordinary income from partnership activities here. But note, you can't net partnership income against partnership losses on this line. Ordinary losses from other partnerships would generally go down in the deduction section. Other less common things include certain transferred losses from foreign branches or LIFO recapture amounts if you switch inventory methods. For anything unusual on line 10, it's always a good idea to attach a statement explaining what it is.
Transparency is key. Okay, income covered. Now for the section everyone really wants to master, deductions, lines 11 through 28. This is truly where smart tax planning can make a massive difference to the bottom line. These aren't just expenses, they are opportunities. Let's really break this down, focusing on what qualifies any limits and how corporations can maximize these.
Couldn't agree more. This is the tax-saving playbook right here. Good records plus understanding these rules equals lower tax. Let's go through them. Line 12, salaries and wages. Pretty straightforward what you pay your employees. Ordinary and necessary business expense.
Standard deduction.
Right. Line 13, repairs and maintenance. Key here is that it must be for expenses that don't materially add to the value of property or substantially prolong its life. Those would be capital improvements you have to depreciate. Routine repairs, maintenance deductible now. There's also an option to elect to capitalize certain repair costs if you do it for book purposes too, which affects timing. So repair versus improvement distinction is critical. Very. Line 14, bad debts. This is for debts owed to the corporation that became totally worthless during the year. You use the specific charge-off method, but remember that rule for cash method taxpayers.
Right, you can't deduct it unless you previously included it in income.
Exactly. If your cash basis and a client just never pays your invoice, you can't deduct it as a bad debt because you never recorded the income in the first place. Line 15, rents. Rent paid for property used in your trade or business, generally deductible.
Okay, now line 16, taxes and licenses. This trips people up. What taxes can you deduct, and maybe more importantly, what taxes are absolutely not deductible?
This is a huge area for potential mistakes. You can generally deduct taxes paid or accrued during the year if they're imposed on the business. Things state and local income taxes, real property taxes on business property, employer's share of employment taxes, sales tax, if it's imposed on the business as the purchaser.
Okay, seems reasonable. What's not deductible?
Several big ones. Federal income taxes themselves obviously can't deduct those.
No.
Foreign income taxes, if you're claiming the foreign tax credit for them, you choose credit or deduction, not both.
Right.
Tax is not actually imposed on the corporation. Like sales tax collected from customers and remitted to the state isn't the corporation's tax expense. Taxes paid when acquiring property, those get added to the cost basis of the property. Taxes paid when selling property, those reduce the amount realized on the sale. And taxes assessed for local benefits that tend to increase the property's value, like special assessments for sidewalks or sewers, those usually increase basis instead of being deductible. Knowing these non-deductible categories is vital.
Super important distinction. Okay, what about interest expense? Line 17. Is all interest paid deductible?
Ah, interest. Not always straightforward, especially because of Section 163J. This section imposes a limitation on the deduction of business interest expense. It's a really big deal for many companies, particularly those with a lot of debt.
The Section 163J limitation, how does that work generally?
Generally, your deduction for business interest expense is limited to the sum of your business interest income for the year, plus 30% of your adjusted taxable income, which is roughly EBITDA for most businesses, though the calculation is specific, plus any floor plan financing interest relevant for vehicle dealers.
So basically, your interest deduction is capped, often around 30% of your earnings, before interest, taxes, depreciation, and amortization.
That's the gist of it, yeah. If you're highly leveraged or have lower earnings, a significant chunk of your interest expense might not be deductible in the current year. It changes the math on debt financing.
What happens to the interest you can't deduct? Is it lost forever?
No, thankfully. Any business interest expense disallowed under the 163J limitation is carried forward indefinitely to future tax years, where it can potentially be deducted subject to the same limitation in those years.
Okay, so it's deferred, not lost. Do you need a special form for this?
Yes. If this limitation applies to you, you must file Form 8999, Limitation on Business Interest Expense, under Section 163J to calculate your allowed deduction and your carry-forward amount. This is a critical compliance point and a major planning area.
Definitely sounds like something to plan around. Okay, moving on to line 18, charitable contributions. This always feels like a positive one, doing good and getting a tax break. How does it work for corporations?
It absolutely can be a win-win. Corporations can deduct contributions they actually paid during the tax year to qualified organizations, charities, certain veterans organizations, governmental units for public purposes, etc. Plus, you can deduct unused contribution carryovers from prior years.
Okay, actually paid during the year, but I feel like I heard something about accrual basis companies getting some flexibility here.
You heard right. This is a fantastic tax-saving tip specifically for accrual basis corporations. You can elect to treat a charitable contribution as paid during the tax year, even if you actually pay it after year-end, as long as two conditions are met.
What are the conditions?
1, the corporation's board of directors has to authorize the contribution during the tax year. 2, the contribution must actually be paid by the 15th day of the 4th month after the close of the tax year, essentially, by the original due date of the tax return, before extensions.
Wow, so the board approves it in December, you pay it the following March, you can deduct it on the December year-end return.
Exactly. You just need to attach a declaration to the return stating the board resolution was adopted and the date. This is huge for year-end planning. If you have a profitable year, the board can authorize a donation late in the year, you pay it early the next, but you get the tax deduction against the profitable year's income now, speeding up the tax savings. That's a real cash flow benefit.
That is a powerful planning tool. Is there a limit on how much you can deduct overall for charitable contributions?
Yes, there's a ceiling. Generally, the total charitable contribution deduction for a corporation cannot exceed 10% of its taxable income.
10% of taxable income. How is that taxable income calculated for the limit?
It's calculated before taking the charitable contribution deduction itself, before certain special deductions like the dividends received deduction we'll talk about later, before certain bond premium adjustments, and without regard to any net operating loss or capital loss carrybacks to the year.
Okay, 10% of a specific modified taxable income figure. What if your contributions are more than 10%?
If your contributions exceed the 10% limit, the excess isn't lost. It can be carried over and deducted in the next 5 tax years, subject to the 10% limit in those future years. So you still eventually get the benefit, just spread out over time. This carryover is another key planning aspect, especially if you have a year with unusually large donations.
Good to know it's not wasted. Okay, let's keep moving through these deductions. What's next after charity?
Line 19 is depreciation. This is where you deduct the cost of your tangible assets. buildings, machinery, equipment, vehicles over their useful lives. It also includes the Section 179 expense deduction.
Ah, Section 179, that lets you write off the full cost of some assets immediately, right?
Exactly, up to certain limits. It's a powerful incentive for businesses to invest in new equipment. You calculate depreciation and Section 179 on Form 4562, depreciation and amortization, and the total flows to line 19.
Got it. Form 47072 feeds into this line. What's line 20, depletion?
Depletion is similar to depreciation, but it's for natural resources, oil, gas, minerals, timber. It allows you to deduct the cost of these resources as you use them up. There are also specific rules here for things like foreign intangible drilling costs or foreign exploration costs. You might have an option to deduct them currently or capitalize and amortize them over 10 years.
Specific to resource-based industries. Line 21, pension, profit sharing, etc. plans.
This is the deduction for contributions the corporation makes to qualified retirement plans for its employees, like 401k, defined benefit plans. These are crucial employee benefits, and the contributions are generally tax-deductible for the company, within limits. Companies with these plans usually have to file Form 5500 annually as well.
Right, the big retirement plan information return.
Yep. And there are penalties for not filing that, or for overstating your pension contribution deduction on the 1120. Line 22 is for employee benefit programs. This is for contributions to other types of benefit programs not deducted elsewhere, like group term life insurance premiums within limits, or accident and health plan contributions.
Okay. Now, line 23 looks interesting. Energy efficient commercial buildings deduction. You mentioned this earlier. Sounds like a targeted tax break.
It absolutely is, and it's often overlooked but can be quite valuable. This is Section 179D. If your corporation makes qualifying expenditures to increase the energy efficiency of a commercial building it owns, or leases things like efficient lighting systems, HVAC, or building envelope improvements, you can claim this deduction.
So it incentivizes going green with your buildings.
Precisely. It requires filing Form 72005 to claim it. It's a direct tax benefit for making those energy-saving investments. Definitely worth looking into if you've done upgrades or are planning them.
Good one to flag. Okay, now we hit line 26. Other deductions. The famous catch-all line. But you said it contains hidden gems and potential pitfalls. What kinds of things land here?
It's definitely a mixed bag. You must attach a statement detailing exactly what you're deducting on this line, type, and amount. Common items include amortization, which is like depreciation for intangible assets, goodwill, patents, certain startup costs. You usually figure this on Part 6 of Form 4562.
Amortizing intangibles. Okay.
Also, there's a special deduction under Section 181 for certain costs of qualified film, television, or live theatrical productions. You can potentially deduct up to $15 million immediately, sometimes more in specific distressed areas. Big incentive for those industries.
Interesting. What about cost for starting a new business? That's a huge expense for entrepreneurs. Where do those go?
Yes. This is a key hidden gem often found on line 26 via amortization. Business startup costs, investigating and creating the business before it opens, and organizational costs, costs to actually form the corporation, like legal and state filing fees, get special treatment.
How so? Can you deduct them right away?
Partially. You can elect to deduct a limited amount of each type of cost in the year the business begins. For 2024, that limit is up to $5,000 for startup costs and up to $5,000 for organizational costs. However, this $5,000 limit is reduced dollar for dollar if your total costs exceed $50,000 for either category.
Okay, so up to $5,000 up front, potentially less if you spend a lot. What about the rest?
The remaining costs, anything over the $5,000 you deduct immediately, are then amortized, meaning deducted straight line over a period of 180 months. That's 15 years, starting with the month the business begins.
So small immediate deduction and a long write-off period for the rest. Still helpful for new businesses.
Absolutely.
Yeah.
Getting even that $5,000 or $10,000 upfront deduction provide the valuable cash flow boost in those critical early years.
Yeah.
It's an election you need to make properly, but definitely worthwhile.
Good to know. What else falls under other deductions?
Let's see. Reforestation costs, you can deduct up to $10,000 per year for qualifying expenses to plant or seed forests for timber. Also, certain dividends paid on stock held by an employee stock ownership plan, or ESOP, under Section 404K. And then, the big one, travel, meals, and entertainment. This is where things get really specific and often scrutinized.
Yes, T&E, always a hot topic. What are the key rules here to make sure expenses are actually deductible and avoid IRS headaches? This feels like an area ripe for mistakes.
It absolutely is. The rules are strict and have changed over the years. Let's break it down. First, travel expenses for someone accompanying a corporate officer or employee, like a spouse. Generally not deductible unless that accompanying person's also an employee, their travel serves a bona fide business purpose, and their expenses would be deductible anyway. Very narrow exception.
Okay, spouse travel is usually out. What about meals? Business lunches, dinners?
Meals are tricky. Generally, you can only deduct 50% of the cost of business meals. And the meal expense can't be lavish or extravagant under the circumstances. Plus, an employee of the corporation, or the taxpayer themselves if self-employed, generally has to be present when the food or beverages are provided.
50% limit, not lavish, employee present. Got it. What if a meal is part of, say, an entertainment event, like dinner before a show?
Crucial point. If the meal cost isn't stated separately from the entertainment cost on the bill or invoice, then generally no deduction is allowed for the meal or the entertainment. The entertainment itself is usually non-deductible anyway, and failing to separate the meal cost means you lose that 50% deduction too. Itemized receipts are key here.
Wow, so lumping meals and entertainment together can kill the meal deduction entirely. That's harsh.
It is. The IRS wants clear separation. Now, speaking of related things, qualified transportation fringes, or QTFs, things like employer-provided parking, transit passes, commuter vehicle benefits, a major change a few years ago made these generally non-deductible for the employer. So the company can't write off the cost of providing those specific benefits anymore.
No deduction for providing parking or transit passes. Ouch. What about membership dues, like country clubs or professional organizations?
Big difference there. Dues paid to professional, business, or civic organizations, like a chamber of commerce or trade association, are generally deductible. It's related to your business. However, dues paid to clubs organized for business, pleasure, recreation, or other social purposes are generally not deductible. This specifically includes country clubs, golf clubs, athletic clubs, airline clubs, hotel clubs. The primary purpose matters. If it's mainly social or recreational, no deduction for dues.
So that golf club membership isn't a write-off, even if you talk business there sometimes.
Generally, no. The primary purpose rules. Similarly, expenses for entertainment facilities, yachts, hunting lodges, swimming pools, apartments used for entertainment, are generally not deductible at all.
Okay, facilities are out. Is there any way to deduct entertainment-type expenses?
There's a narrow exception if the amounts are treated as compensation to the recipient. If you provide, say, entertainment or recreation that would normally be non-deductible, but you treat its value as wages to an employee, reported on Form W-2, or as non-employee compensation to an independent contractor, reported on Form 1099 NEC, then the corporation might be able to deduct that amount as compensation expense.
Ah, so you can deduct it if you tax the recipient on it.
Basically, yes. But there are special complex rules if the recipient is a specified individual, like a high-ranking officer or director, which might still limit the deduction. It's not a simple workaround.
Sounds complicated. What about fines and penalties paid to the government? Can you deduct those?
Generally, no. Fines or similar penalties paid to a government entity for violating a law are typically non-deductible. The government doesn't want to subsidize lawbreaking.
Makes sense. Any exceptions?
There are very specific, narrow exceptions. For instance, amounts paid for restitution or to remediate property damage caused by the violation might be deductible, if identified as such in the court order or settlement agreement. Amounts paid to come into compliance with a law might also be deductible. And amounts paid that constitute taxes due are deductible as taxes, not penalties. But the rules are strict, and you need clear documentation linking the payment to one of these exceptions. Costs of investigations or litigation itself generally don't qualify for these exceptions.
Okay, mostly non-deductible. Last one in this category, lobbying expenses, trying to influence legislation.
Generally not deductible. Expenses paid or incurred to influence federal, state, or even local legislation are disallowed. This also includes costs for trying to influence certain high-level federal executive branch officials. If you pay dues to a tax-exempt organization, like a trade association, that engages in lobbying, a portion of your dues might become non-deductible too.
So trying to sway politicians is usually on your own dime.
Pretty much. There is a small de minimis exception for in-house lobbying expenditures. If your total in-house lobbying costs for the year are $2,000 or less, you can deduct them. But anything more, or payments to professional lobbyists, generally no deduction.
Wow. Line 26, other deductions, is just packed with critical rules and potential traps. Understanding these details is absolutely essential for getting your deductions right and saving tax legitimately. It's definitely not just a dumping ground for random expenses.
Not at all. Precision is key throughout this whole section.
Okay, let's move into some more advanced topics and key schedules, starting with something potentially very powerful. The Net operating loss, or NOL, deduction on line 29A. How can a loss in one year save you money in other years?
The NOL deduction is a really important mechanism. It allows a corporation that has negative taxable income in one year and net operating loss to use that loss to offset positive taxable income in other years. It smooths out the ups and downs of business cycles for tax purposes.
So you carry the loss to profitable years.
Exactly. On line 29A, you deduct the total NOL carryovers from prior years. You can't deduct more than your current year's taxable income after special deductions, but it can significantly reduce or even eliminate your tax liability in a profitable year.
Sounds great. Are there limits or special rules on using NOLs?
Oh yes, some very important ones. First, if the corporation undergoes an ownership change, basically, a significant shift in who owns the stock. Defined under Section 382, the amount of NOLs generated before the ownership change that can be used after the change might be severely limited each year. This requires complex calculations and disclosures.
So buying a company just for its NOLs isn't so simple?
Not anymore, no. Section 382 puts tight restrictions on that. Second, and this is huge, for NOLs generated in tax years beginning after December 31st, 2017, the deduction in any carryover year is generally limited.
Limited how?
It's limited to the lesser of the total available NOL carryovers to that year, or are 80% of the corporation's taxable income for that year, calculated before the NOL deduction itself and a couple of other specific deductions.
80%. So post-2017, NOLs generally can't wipe out more than 80% of your taxable income in a future year.
That's the general rule, yes. It means even with large NOL carryforwards, corporations might still owe some tax in profitable years. Think of it as the IRS ensuring they get at least a small piece, even if you have old losses. There's an exception to this 80% limit for certain insurance companies, but for most C-Corp, that 80% cap applies to newer NOLs.
That 80% limit is a major change from older rules. Does a corporation have any strategic choices with its NOLs? Like, can they choose not to carry it back?
Yes, absolutely. And this is a key strategic decision. NOLs generated in recent years generally don't have a carryback period anymore, with some exceptions like farming losses. They only carry forward indefinitely. But for NOLs arising in certain prior years that did have carryback potential, or if rules change, corporations could elect to waive the entire carryback period.
Why would they do that? Why not get the refund from a carryback sooner?
Good question. You might waive the carryback if you expect to be in a significantly higher tax bracket in future years. Carrying the NOL forward could save you more tax overall than carrying it back to offset income tax at lower rates in the past. It's a projection game.
Okay, so you forego the immediate refund for potentially larger savings later. How do you make that election?
You typically make the election to waive the carryback by checking a specific box on Schedule K, Item 11 of the Form 1120 for the year the NOL arose, and you file that return by its due date, including extensions. It's generally an irrevocable election, so you need to consider it carefully.
A crucial planning point when you have a loss. Okay, next up, line 29B, special deductions. This links to Schedule C, which covers dividends, inclusions, and special deductions. You mentioned this is where corporate structure and investments really matter for tax savings.
Absolutely. Schedule C is home to some very significant corporate tax benefits, arguably the most important being the dividends received deduction, or DRD.
The DRD, tell us more about that. How does it work?
The DRD allows a corporation to deduct a certain percentage of dividends it receives from other domestic corporations. The idea is to mitigate triple taxation, where earnings are taxed at the subsidiary level, then again when paid as dividends to the parent corp, and potentially again when the parent pays its shareholders.
Okay, so it reduces tax on intercompany dividends. What are the percentages?
It depends on how much stock your corporation owns in the dividend-paying corporation. If you own less than 20%, you can generally deduct 50% of the dividends received. If you own 20% or more, but less than 80%, the deduction jumps to 65%.
50% or 65%. That's a pretty substantial deduction already. Are there situations where you can deduct even more? Like 100%?
Yes, there are. The 100% DRD is available in specific situations, often involving closely related companies. For example, dividends received from a corporation that's a member of the same affiliated group, think parent subsidiary where the parent owns 80% or more, can qualify for a 100% DRD, provided certain conditions are met. Although if they file a consolidated return, those dividends are usually eliminated anyway. You can also get a 100% deduction for certain dividends from 100% owned foreign subsidiaries under specific rules, Section 245B, and for certain dividends from former foreign sales corporations, FSCs. This 100% deduction is obviously extremely valuable for moving cash up from subsidiaries tax efficiently within a corporate group.
So holding stock in other domestic core, especially related ones, can generate significant tax savings via the DRD. Are there any catches, limitations, or dividends that don't qualify?
Definitely catches. First, there's a limitation based on taxable income. Generally, the total DRD, the 50% and 65% ones combined, cannot exceed a corresponding percentage, 50% or 65% of the corporation's taxable income, calculated before the DRD and some other items like NOLs.
Another taxable income limitation.
Right. But here's a huge planning point. This taxable income limitation does not apply if allowing the full DRD actually creates or increases a net operating loss for the year.
Wow, so if the DRD pushes you into a loss, you get the full deduction anyway.
Exactly, that's a critical exception. It means the DRD can be fully utilized even in low-income years if it generates an NOL. Other restrictions. You generally can't claim the DRD if you held the stock for less than 46 days, or 91 days for certain preferred stock. This prevents short-term dividend stripping strategies.
Holding period requirement. Makes sense.
Also, no DRD if the dividend is on stock where you're obligated to make related payments on substantially similar property, like in certain short sales. And dividends from certain entities like REITs or ICs generally don't qualify for the DRD, though capital gain distributions might. Dividends on certain debt-financed stock might also have reduced DRD. Schedule C also includes other complex items related to foreign income, like Subpart F inclusions and GILTI, Global Intangible Low-Taxed Income.
GILTI sounds complicated.
It is. These are anti-deferral rules designed to tax U.S. corporations currently on certain earnings of their foreign subsidiaries, particularly intangible income parked in low-tax countries. There's also a related deduction, the Section 250 deduction, which provides a partial offset for GILTI and also for foreign-derived intangible income, FDII, which incentivizes exporting goods and services linked to U.S. intellectual property. These are highly complex international tax areas.
Definitely sounds like specialist territory again. Okay, that's a deep dive into income reduction. Now let's get to Schedule J, tax computation and payment. The moment of truth, calculating the actual tax bill and seeing what reduces it.
Right. Schedule J is where it all comes together. Line 1A is the main event, income tax. For C corporations, it's currently a flat rate 21% of your taxable income from page 1, line 30. Nice and simple compared to graduated rates of the past.
Flat 21%. Okay.
Yeah.
Any other taxes calculated here?
Line 1B is for a very specific case involving mutual savings banks with life insurance business. Most companies skip that. Then you might have other taxes added, like the personal holding company tax on line 7, which applies to certain closely held corporations with mostly passive income, designed to prevent using a C Corp as a personal investment vehicle. Or various recapture taxes on line 9 if you previously claimed certain credits, like the new markets credit or Indeed employment credit, and then stops meeting the requirements, you might have to pay some of that benefit back.
Okay, so potential add-on taxes, but what about things that reduce the tax? Credits.
Yes, line 6, total credits, is huge. This line sums up various tax credits the corporation is claiming, primarily from Form 3800, the general business credit. And credits are fantastic because they reduce your tax liability dollar for dollar. A deduction reduces your taxable income, but a credit directly reduces your tax owed.
Dollar for dollar savings, that's powerful. What are some common examples of these general business credits that flow into Schedule J?
There's a whole array of them, designed to incentivize specific business activities. Really valuable stuff. For example, the Work Opportunity Tax Credit, WOTC, for hiring individuals from certain targeted groups facing employment barriers. The credit for increasing research activities, the R&D tax credit, which is massive for innovative companies, the orphan drug credit for developing treatments for rare diseases.
Those sound significant. Any others?
Loads. The disabled access credit for making your business successful. The empowerment zone employment credit for hiring residents of those zones. Credit for employer Social Security and Medicare taxes paid on certain employee tips. The FICA tip credit, huge for restaurants.
Good.
Credits for small employer pension plan startup costs. Employer-provided childcare facilities and services credit. Low sulfur diesel fuel production credit. Employer differential wage payments credit for paying employees on active military duty. Small employer health insurance premiums credit for SHOP marketplace coverage. Credit for paid family and medical leave.
Wow, that's a long list. It really pays to investigate which of those your business might qualify for.
Absolutely. Each one represents direct tax savings, potentially thousands or even millions of dollars depending on the company and the credit. Don't leave these on the table.
Definitely not. Okay, after calculating the tax and subtracting credits, Schedule J moves into payments, right?
Correct. The bottom part of Schedule J deals with payments made and certain refundable credits. Line 14 is where you report the total estimated tax payments you made during the year. Line 15 subtracts any quick refund you already applied for using Form 4466. Line 18 is where you claim credit for any federal income tax withheld from payments the corporation received, maybe backup withholding or withholding on foreign partners' share of income, Form 8805, or withholding on dispositions of U.S. real property interests, Form 8288A. You need the supporting forms, like 1099, 8805, 8288A attached.
Okay, accounting for payments made. Then line 20 mentions refundable credits. How are these different from the general business credits?
Refundable credits are like cash in hand. Unlike non-refundable credits, like most general business credits, which can only reduce your tax liability down to zero, refundable credits can actually result in a refund payment from the government, even if they exceed your total tax liability.
So you could owe zero tax but still get money back from these.
Exactly. Examples include the credit from Form 2439. This is where a regulated investment company, RIC, or a REIT pays tax on undistributed capital gains, but passes the credit through to its shareholders, including corporate shareholders. Also, the credit for federal tax paid on fuels claimed on Form 4136, often for off-highway business use of fuels. And credits for taxes withheld under Chapter 3 or 4, like on certain payments to foreign entities, shown on Form 1242 ESSA. These are direct money back to the corporation.
Very valuable then. Okay, that covers the tax calculation and payments. Let's pivot to Schedule K, other information. This looks like a list of yes/no questions, but you said they can trigger other forms or have big implications. What should we focus on here?
Schedule K is definitely more than just checkboxes. It's where the IRS gathers information on various aspects of the corporation's structure, ownership, and activities. Questions 4 and 5 ask about constructive ownership, basically, whether certain individuals or entities indirectly own stock in the corporation, or if the corporation owns stock in other entities, according to complex attribution rules. If you answer yes, you might need to attach Schedule G with more details.
Complex ownership structures get flagged there. What else?
Question 7 is critical. Foreign ownership. Did one foreign person, individual, corporation, partnership, etc., own 25% or more of the corporation's stock by vote or value at any time during the year? If yes, you must check yes, identify the owner's country, and this generally triggers the requirement to file Form 5472, information return of a 25% foreign-owned U.S. corporation or a foreign corporation engaged in a U.S. trade or business.
Form 5472. And you mentioned penalties for not filing that are severe?
Extremely severe. The baseline penalty starts at $25,000 per required form per year and can increase significantly if the failure continues after IRS notification. It's a major compliance hotspot for international businesses.
Okay, definitely don't miss that if it applies. What else on Schedule K is noteworthy?
Item 9 asks about tax-exempt interest received or accrued. Even though it's not taxed, you report the amount here. It's important for reconciling your book income to your tax income on Schedule M1 or M3. Transparency. Then jumping way down, question 27, the digital assets question. This is relatively new and super important now.
Right, the crypto question. What exactly did they want to know?
They want to know if, at any time during 2024, the corporation engaged in certain transactions involving digital assets. The definition is broad. Crypto, NFTs, stablecoins, anything using similar distributed ledger tech. You must check yes if the corporation received digital assets as a reward, payment for services, etc., or if it's sold, exchanged, or otherwise disposed of a digital asset or financial interest in one.
So receiving crypto as payment, mining crypto, selling crypto, trading one crypto for another, all trigger a yes.
Correct. Buying crypto with fiat currency, like US dollars, holding crypto, or just moving it between your own wallets generally does not require yes. But any transaction where you acquire it, other than by purchase, or where you get rid of it, means checking yes, and you cannot leave it blank.
How do you report the actual income or gain loss from these?
If you sold or exchanged digital assets held as capital assets, the gain or loss goes on Form 8949 and Schedule D, just like stocks. If you receive digital assets as income, like payment for services or for mining staking, you report it as ordinary income, typically under Other Income on page 1. This question is a clear signal the IRS is focused on digital asset compliance.
Absolutely. What about question 28, controlled group?
If the corporation is a member of a controlled group of corporations, parent subsidiary or brother or sister group with common ownership, you check yes and you must attach. Schedule O. Schedule O is used to allocate certain tax benefits, like the lower tax brackets if they existed, or certain credit limitations. among the members of the group. Ensures one group doesn't get multiple benefits meant for single corporations.
Allocating benefits within a related group. Makes sense. Any other Signal K highlights? Hybrid arrangements. Section 7874.
Quickly, yes. Question 21 asked about payments under hybrid arrangements where deductions might be disallowed under Section 267A complex anti-abuse rules targeting cross-border tax avoidance. Question 26 relates to Section 7874, the anti-inversion rules, relevant if a foreign corporation acquires substantially all the properties of a domestic corporation. It can affect whether the resulting entity is treated as domestic for tax purposes or faces reduced tax benefits. Question 31 flags potential reporting requirements for partnerships with significant basis adjustments involving controlled group partners. These are all fairly advanced specialized areas.
Definitely need expert advice for those. Okay, let's briefly touch on the last few schedules. Schedule L, the balance sheets per books. What's its purpose?
Schedule L is just that the corporation's balance sheet, assets, liabilities plus equity, based on its accounting books, shown for the beginning and end of the tax year. The IRS uses it to see the company's financial position and verify consistency with the income statement and other parts of the return.
A financial snapshot. Then Schedule M1, reconciliation of income, loss per books with income per return. Why is this needed? Why don't book income and tax income match?
They often don't match because the rules for financial accounting, GAAP usually, and the rules for tax accounting are different in many areas. Schedule M1 bridges that gap. It starts with your net income per books and then lists adjustments, additions, and subtractions to arrive at your taxable income before NOLs and special deductions, which should match the number on page 1.
What kind of adjustments are common?
You add back things that were expenses for book purposes but aren't deductible for tax. A huge category here on line 5C is non-deductible expenses. This is where you'd add back that non-deductible 50% portion of meals, any non-deductible entertainment expenses, non-deductible club dues, federal income tax expense recorded on the books, penalties, the non-deductible portion of lobbying expenses, etc.
So adding back all those items we discussed earlier that the IRS doesn't allow.
Exactly. On the other side, line 7 is for income recorded on the books that isn't taxable. The prime example is tax-exempt interest income from municipal bonds. You subtract that here because it's book income but not tax income. Tax-exempt PPP loan forgiveness would also factor in here if included in book income initially.
Reconciling the differences, is Schedule M1 always required?
Not for very small corporations. If your total receipts and total assets are both less than $250,000 for the year, you generally don't have to complete Schedule L, M1, and M2, provided you check the box on Schedule K, question 13. That's a nice simplification for smaller businesses.
Good threshold to know, but larger companies have to do it.
Yes. And corporations with total assets of $10 million or more must file the much more detailed Schedule M3 instead of M1. Schedule M3 requires a much more granular reconciliation of book tax differences. Some companies below the threshold might file M3 voluntarily too.
Okay. And lastly, Schedule M2, analysis of unappropriated retained earnings per books. What does this show?
Schedule M2 just reconciles the changes in the corporation's retained earnings account on its books from the beginning to the end of the year. It starts with the beginning balance, adds net income per books from M1, subtracts distributions like dividends paid to shareholders, and accounts for other adjustments to arrive at the ending retained earnings balance, which should tie back to Schedule L. It completes the picture of how profits flow through the company's equity. Adjustments related to PPP loan forgiveness amounts might also show up here if the final forgiven amount differs from what was initially booked.
Got it. It connects all the financial statements. Whew. That was an incredibly detailed tour through Form 1120 and its key schedules. But let's step back for perspective. Preparing this, it's a lot of work. What's the real taxpayer burden involved here? How much time and money are we talking about?
It's significant and often way more than people realize. The IRS actually estimates this burden. For all taxable corporations filing Form 1120, the average estimated burden is around 100 hours of record keeping, learning, preparing, and sending the form, and the average out-of-pocket cost
Up
of $7,400.
100 hours and over $7,000 on average.
Yeah. Now break it down. For small taxable corporations, those with assets under $10 million, the average is lower, but still substantial. About 50 hours and $3,500.
Still a big chunk of time and money for a small business.
Absolutely. But look at large taxable corporations' assets over $10 million. The average burden skyrockets to 690 hours and nearly $60,000 in estimated costs.
690 hours. That's like a third of a full-time employee's year. And $60,000. That's staggering.
It really highlights the complexity involved, especially for larger, more complex organizations. These numbers vary wildly, of course, based on the specifics of the business, the quality of records, the software used, whether they use in-house experts or outside firms. But the bottom line is, corporate tax compliance is a major operational undertaking and a significant cost center.
It's definitely not just filling out a form. It's a major process. So given this huge burden, but also the clear opportunities for savings we've discussed, what's the real value in being so well informed about these rules rather than just handing a shoebox of receipts to an accountant?
The value is immense. Understanding these instructions, especially the deductions, the credits, the limitations, the elections, it's not just about compliance, about ticking boxes and avoiding penalties. It's about optimization. It's about strategically managing your corporation's finances to minimize your tax liability legally and keep more capital working in the business.
So knowledge really is power here.
Absolutely. Knowing what's possible allows you to structure transactions thoughtfully throughout the year. It empowers you to ask your tax advisor smarter questions, to challenge assumptions, to make sure you're not leaving money on the table because you didn't know a certain deduction or credit existed or how to qualify for it.
Yeah, this deep dive should definitely equip our listeners to have much more productive conversations with their tax pros, or even tackle parts of it themselves with more confidence, knowing where the real leverage points are.
Precisely. And that ties into the final really crucial takeaway, proactive planning. So many of the tax-saving strategies we've hit on the charitable contribution election for accrual taxpayers, managing around the 163J interest limit, identifying and claiming those general business credits, properly documenting and electing to deduct startup costs, they require planning and action throughout the year, not just scrambling in March or April.
You can't just wait until tax time to think about this stuff.
Exactly. And the foundation for all of it, meticulous contemporaneous record keeping. You need the documents, the proof, organized as you go, to actually substantiate the deductions and credits you want to claim. Without the records, even the most legitimate deduction can be disallowed on audit. Proactive planning and solid record keeping are the twin pillars of effective corporate tax management.
What a journey. We went from the basics of who files Form 1120 and when, navigating the income reporting, and then really diving deep into the power of deductions and credits, the real engines for tax savings. It's clear that mastering these details isn't just a compliance headache, it's a strategic advantage. It empowers you to manage your corporate finances more effectively and, let's be honest, keep more of your hard-earned money working for your business.
Well said.
So, as you think about everything we've covered today, the complexity, the burden, but also the significant opportunities, here's a final thought to chew on. Given the sheer amount of time and money spent on corporate taxes, and the long list of specific targeted deductions and credits available, what proactive steps can your corporation take, starting now, not next tax season, to strategically minimize its tax liability? Take a hard look at your business activities. Compare them against the deductions we discussed. Are there opportunities you're overlooking simply because you weren't aware of the rules? Identifying even one or two could make a real difference to your bottom line.